I welcome you all for this study circle meeting on the topic Common Errors in Financial Reporting, AS and Ind AS. And to handle this session, we have none other than CA Mohan R Lavi sir. Can I request our Vice Chairman, Kamala Legre, to escort the speaker onto dance and then welcome him to the floor. I request Vice Chairman to give the yes.
Good evening, members. I extend a warm welcome to all of you who gathered for this study circle meeting. It's a truly pleasure to see such an inquisitive gathering and to see inquisitive minds and the professionals dedicated to excellence in the field of accounting. Today's topic is very crucial for the various practices which we dwell. And as we delve into the topic of critical importance and relevance, common errors in financial reporting, AS and Ind AS, the intricacies of financial reporting standards are pivotal and is ever evolving. Business landscape and understanding these nuances plays a very key and crucial role in our professional growth. We are incredibly fortunate that we have CA Mohan R Lavi, luminary in the field of accounting and financial reporting. His expertise and insights today will both on accounting standards, on Indian accounting standards, are not only an alignment but also essential for us continuous professional growth. So please ask your doubts. I know Ind AS being a relatively new, it's been quite a long time, so I can't use the word new, but at least for the people who are practicing it, make use of it. People who are not practicing and think of practicing, please ask your respective questions. Because what I always say is, the silly doubts are not the one which we ask, and the one which we don't ask is probably which will benefit all the members. So ensure that you ask your questions. Also, I had two announcements to make. I know I see the full hall because of the CPE deadlines. I think ICAI has sent an exposure draft, if most of you are aware. And we see that most of us don't respond to this exposure draft, and most of the exposure draft, if you see, even on the CPE guidelines, it says it's very mandatory in the block of year. And if you don't respond, probably that will become the norm later. So later on you can't complain. So please give your comments on the exposure draft so that everyone will be benefited out of this. And recently, ICAI Ethical Standard Board has come up with a new initiative. I know advertising is a taboo in our profession, but considering the challenges faced by us and to get a global reach out, ICAI has come up with this CA Connect portal. So make use of it. All the data are pre-filled, so you have to register once, and you can, going forward, ask your clients in case if anyone searches, your probably name is listed and you might get some global opportunities also. Please, of course, don't hold me responsible. With this, I welcome you all. Let's have a great learning ahead. Thank you.
Thank you, Rishi. Members, I have the privilege in introducing today's speaker. He doesn't require any introduction, but still as a duty. Mr. Mohan R Lavi is a qualified chartered accountant. He is qualified in the year 1989. He has over 25 years of experience in industry across a variety of industries. He has worked as senior in finance in manufacturing and software companies. Mohan also has over 6 years of experience in practice. At present, he is the partner with Messrs. KP Rao & Co. Chartered Accountants, Bangalore, and heads the Ind AS and GST practices of the firm. Mohan is the author of books on IFRS and Ind AS, key audit matters and other related topics. Mohan has spoken at various conferences in India and abroad on accounting standards, IFRS, Sarbanes-Oxley and GST, and is a faculty member with the Institute for their IFRS certification course and registered valuers program. His articles appear frequently in the Hindu, Business Line, Deccan Herald and Bombay Chartered Accountants Journal. With this brief introduction, I present before you CA Mohan R Lavi sir. Over to you, sir.
So good evening to all the members. First, thanks to Pramod and Manjunath for inviting me to talk on this topic of common errors in financial statements. In fact, when they asked me last month, they said the entire December is only going to be common errors in financial statements, common errors in auditing standards, common errors in GST. They're going to have common errors for all the topics, they said. Which probably made me feel they're probably making too many errors in all possible areas of practice. But as Pramod was saying, I think what we should look at is the fact that it's not a fault-finding mission. Let me be very, very clear on that. It's not a fault-finding mission. And I think this common errors, we've got to sort of mingle with or merge it with our quality standards, our code of ethics and other standards also. So I think it's a very holistic sort of an approach. It's not that if you give me a file, I find out mistakes in it. It's not just on a one-to-one basis like that. I think the entire, what you can say, trend seems to be that improving our quality. Now, you all may ask me, why is it required? Why do we require a session on common errors when you can see so many errors coming out today? So much of information is in the public domain. All of you know about NAFRA website, all of you have seen NAFRA orders, all of you have seen SEBI orders. Why is it required that we should actually tell the members that these are some of the mistakes which many of the members have probably been making? And I mean, when I say members, I also talk about the companies, because we should not forget that the people who are making the mistake initially are the companies. It's the entities who are making the mistake first, and we are sort of, probably signing off on that. So I think that will be the trend of today's session. I'll cover both AS and Ind AS, and as Pramod said, Ind AS is still a topic which can be debated a lot. People are still learning Ind AS. People don't know about Ind AS even today, because we have standards, we've got 39 standards, we've got 40 standards coming up now. Implementation has happened somehow it is implementation has happened, but there have been a few issues which we can discuss as we go along on both the AS as well as the Ind AS standard. Okay, why is it required? So as I already told you all, suddenly over the last 10 years, we are observing that everybody is looking at the work we are doing. I am talking about as professionals. And you can start from SEBI, you can start from Reserve Bank of India, you can start with the Serious Fraud Investigation Office, you can start with the Ministry of Corporate Affairs, you can end up with NFI. Everybody seems to be having some sort of interest in seeing what auditors are doing. I always do mention this when Satyam happened, on the day Satyam happened. We were traveling, we were a group of chartered accountants, there was a conference somewhere in Nellore somewhere. We were traveling from Hyderabad to Nellore. And this lady was in the train, she asked us, what are you people discussing, who are you all of you? We said, chartered accountants, madam, we are going to Nellore for a conference. Her first question was, what happened in Satyam? She was almost trying to allude that somehow chartered accountants were, I won't say involved, responsible in a certain manner or whatever. But today, if something of that sort happens, people don't even ask you, what are you doing? They ask, who's auditor? It has come to that stage today. People don't ask who is the company, they don't ask what has happened. They simply ask who's the auditor now. Because over the last 10 years, as I have said, so much of information about audit profession has spread that they only ask, oh, this person, Pramod is auditor. Pramod won't do like that, no. Why is it done like that? Or maybe fees was too high. I'm not saying Pramod will do it, but I'm just telling you that this is how the discussion has happened. Now, whether it is right or not is not for me to say. But this is reality. We've got to accept the fact that whether it is, I've seen SEBI orders, I've seen SEBI who has probably never come out and spoken about the profession, given orders against chartered accountants for certain non-disclosures and all those things. So I think we need to be a little bit more aware of the fact that it is not only our own reporting, but others also are going to find, we are going to look at our, and when I'm saying others, I mostly talk about the regulators. What do we follow? We've got to follow the Companies Act 2013, we've got to follow auditing standards, for all 46 of them, not all 46 are applicable to the client, but yet we need to ensure that auditing standards are there. AS, in case it's non-Ind AS company, we've got SEBI regulations, we've got RBI regulations, we've got IRD, and now we've got NAFRA also giving their opinions on various topics. NAFRA has recently come out and said that we do accept the fact that auditor is not supposed to find out a fraud. We do accept the fact that the main purpose of audit is not to find out a fraud. But in the course of audit, if he smells a fraud, he is supposed to report it, which is even more dangerous if you ask me. You might as well ask him to find a fraud. How do you smell a fraud? They have said that even if a fraud has been discovered by others, you are supposed to report it under 143 bracket 12. So the responsibility seems to be suddenly increasing, and in that context, I think today what we'll probably look at is certain things which we can avoid, certain mistakes which we can probably avoid doing, and we'll see how we can probably go about it. It is not that we don't have a system of quality review. All of you all will be aware. The next set of peer reviews are already commenced. It's already started. 31st March 24 is the drop dead date for that. QRB has come out and inspected a few firms. They've also done it. NAFRA has been extremely proactive in this. FRB reports have come on at least about 7 or 8 companies. And now all the regulators, as I said, all the regulators have become pretty active in trying to look at work done. I put it this way: financial reporting done by companies and how they have been reported by the auditors. I would like to though point out that the title common errors is probably misguiding. It's errors. Common errors seems to be that we're repeating errors very frequently, which is not a very good thing. It's just errors in financial statements, and I am going to take you all through only some of the errors which, see, there's this thing, right? I mean, all of you will probably agree with what I'm saying. If I tell you that the error has happened, as a post-mortem, you will say, you know what, actually I should have been a little bit more careful. I should have probably taken the necessary, precaution. As a post-mortem, it is very easy to find out an error, which is why all the regulators are finding out these errors. I was just telling Pramod, if I become an audit file of his, I can find out 10 errors and tell him these are 10 errors. It's a post-mortem exercise. The exercise is meant to find errors. I can do that. That is not a problem at all. The challenge for us will be to not to do any errors or minimize the errors during the course of the audit. That is where the challenge comes. So, with so many people looking at it, with so many regulations, a question which all of you all can have is, why do errors ever even occur at all? Because if I restrict myself only to the field of auditing, and I'm assuming at this stage that the companies have already, the financials have sort of been given to you while only doing the audit and all those things. Why do errors occur, or on a different question altogether is, can these errors, so-called errors, what is required for us to ensure that these errors are minimized? So as all of you are aware, financial statements are based on a lot of estimates and judgments. All of you are aware of that. The basis of preparation talks about it. The basis of preparation also discloses prior to the accounting policies what are the significant estimates and judgments which have been made on those set of financial statements. We are all very clear about that. If I throw across a question across this room, and ask you what is the useful life of your mobile phone, which is nothing but an estimate and judgment, I will get 150 responses, all different responses. I will get 150 different responses because each person's estimate is what they feel is the estimate. And if you apply this to financial statements, management has applied a certain degree of estimate and judgment. Auditor has also probably blessed that estimate and judgment. How can there ever be an error? Is one question we have to ask. Okay, if somebody comes and tells me your estimate is wrong, I can defend my estimate, I can defend my judgment. This is the first takeaway we have to look at today. That irrespective of whoever comes and asks you, are you able to defend your judgment? Are you able to defend your estimate? It can be any area, it can be a provision, it can be a write-off, it can be anything. It can be fair valuation. Are you in a position to defend your judgment? How will you defend it? I think that is one question which all of you should definitely think of today, because the day is not far off when these questions will come. And we are not talking only about listed companies now. It is not going to be very far away when QRB, all your peer review board, everybody probably adopts the same stance as what NAFRA is adopting. They may not go to the extent of fault finding, but they will probably want you to improve your quality, want you to document things more properly. You know, those things could possibly happen. So I think we need to understand that errors can probably come up because of the fact that there are people who are making estimates and judgments. I can always come and question your judgment, and thereby I can say that an error has happened. What we will also not discuss today is non-compliance with any accounting standard or Ind AS. I am assuming that all the 29, I won't say 29, but AS 1 to AS 29 and Ind AS 1 to Ind AS 116, all the standards have been followed without any exception. If the standards are not followed, automatically you are supposed to give an adverse opinion in your report. So it's a direct correlation of what cause and effect. Standard not followed, adverse opinion. Standard followed, follow it completely. Despite this, why do errors occur? I am going to give you a few choices. You all can answer, and most of these questions I will expect all of you to also respond. Too many things to do, too little time. This could be one reason, right? I've got to look at companies at Schedule 3, first Division 1, Division 2, then somebody will come and give me an auditing standard, then they'll come and give me one checklist from CARO. There are so many things to do. But I brought, in case of a listed company, only 45 days in the close of the quarter. In the case of a private limited company, he may say, sir, bank loan is urgent sign martira. Even faster than the SEBI results you want, sir, bank loan almost sanction a letter correct sign ಮಾಡಿ ಕೊಟ್ಬಿಡಿ sir ಸಾಕು. At that time, are you going to look at SQC1? Are you going to look at you forget non-compliance, compliance with AS and Ind AS in the first place, right? Whatever the company did. So one of the things can be that we've got too many things to do and very little time to do. How do we solve this? Do we not do the things, or do we still do it with a certain amount of quality? That's something we look at. Lack of guidance on complicated items. Sometimes, especially in Ind AS, this happens. Even in AS, it happens in many cases. There is this AS 29 is thing called as onerous contract. Then you have to provide for the loss immediately. It is just similar to your construction contracts, where you have to account for a loss. The moment you estimate the loss, have an issue. If you go and ask the management, is there any onerous contract? Immediate response is going to be no. He is not going to ask you what is onerous contract. That's the first question he is supposed to ask you. He is not going to ask you what is onerous contract. Because it is going to be very difficult for us to find out an onerous contract from the trial balance. This is an estimate made by the management on losses they will have to incur, or based on the budgets or whatever they are trying to carry forward, whether the unavoidable costs in a contract are more than the revenue, they have to provide for this immediately. So they are not worried about all this definition at all. All they are going to say is no onerous contracts. So it is possible that subsequent if losses are incurred, it can be an error because of the fact that it was not recognized in the year in which the contract. So it will be a non-compliance with AS 29 also. So these sort of errors are something which we require we require a solution for. I will give you an example. Though it's Ind AS, just for complicated items, wherein, bear with me if I am being a little bit technical here, but still. Ind AS has got this thing called as compound financial instrument. Ind AS 32 has got a compound financial instrument concept, wherein, suppose you have a CCPS which is redeemable into convertible into equity shares. When it is issued itself, it will be split into equity and liability component. It's a completely artificial notional classification, nothing to do with actual payout of liability in any of those things. So, if I got 1,000 rupees CCPS, if it is a compound financial instrument, 980 rupees will be the CCPS, 20 rupees will go to equity. At a very broad level, I'm telling you. So we went to some listed company, we went to the standard, they said, yeah, it's a CCPS, we made the accounting entry, we got opinion from 5 people, all 5 people said the same thing. It went to a CA audit. Because it's a public sector company, it was a CA audit. The CA auditor came and asked, ಎಷ್ಟು issue ಮಾಡಿದ್ದೀರಾ? 1,000 rupees. Balance sheet ಎಷ್ಟಿದೆ? 980 sir. 20 ಎಲ್ಲಿ ಹೋಯಿತು? ಈಕ್ವಿಟಿ ಸರ್. ಈಕ್ವಿಟಿ ಇಶ್ಯೂ ಮಾಡಿದ್ದೀರಾ? ಇಲ್ಲ ಸರ್. ಮತ್ತೆ ಎಲ್ಲಿ ಯಾಕೆ ಹೋಯಿತು? Till today, we have not been able to convince him. Why this compound financial instrument has been split? His concept is logically extremely correct. Have you issued equity shares worth 20 rupees, yes or no? Answer is no. Then why are you splitting it? Sir, Ind AS 32. Has Ind AS said you don't issue equity shares? No. So, in many cases what happens, the management just to pass through the audit will take one opinion and say, okay, this opinion is there, you please pass through it. Ultimately, when it goes to the CA that, sir, what do you want to convince yourself that this is a compound financial instrument? They said we require an opinion from the CA Institute, Expert Advisory Group. Until they do a EAG opinion, I am not going to accept this. So we had to go and get a separate opinion from the EAG. And of course, what happened also is completely different, but that's okay. But here's the thing, no? So these are areas wherein at the time of audit, limited time, you have a complicated transaction, extremely possible that in that accounting treatment or disclosure, error can probably crop up. Tax factor also is something you should have to worry about. Many companies who have got, who we don't talk to, let's say Ind AS is talking about this, they say notional income has to be recorded, you have to discount to present value, this, that, for example, onerous contracts, impairment for example is a good example. First question they'll ask me is, can I claim tax benefit? First question is that. Can I show it in my computation income as a deduction? Depending on that, the decision will be taken. Whether an impairment loss has to be recognized or income tax losses, all of you are aware, are still not very clear. And ICDS, as all of you are probably aware, is even more not clear. I always call it as increasing confusion, decreasing simplicity. That's what ICDS is. 10 standards, extremely short standards, based on AS, not even fully copy pasted from AS. Nowhere near Ind AS. So, those problems could probably come in. So, tax factor, whether it is income tax or whether it is GST, could also be a consideration for us to worry about the fact that yes, there can be a possible wrong treatment in the financials, whether we have to look at it, we have to bypass it or not, is something we have to look at. So, in these, these 3 or 4 items, what would be the most popular choice of all of you? These three items, what would you all think? I think the first one will probably be the most popular item, right? If I ask you, the first one will be most popular because all of us are busy. All of us have got our work, all of us have got other things to do also. It's not only this thing, and in the rush of an audit season, one of the things I had against the code of ethics was that there is this AQMM audit. AQMM audit, there is one clause which says that, are you ensuring that people have got enough rest between audits? There's one question, 3-4 marks for that. I don't think any of us will get 4 marks there. Not only for the staff, partners, but also for the staff. Staff, you have to plan who the next person going on leave is. How do you plan for that leave? So with this shortage of resources and a quick time to complete the audit and a deadline, mistakes are bound to occur. Now, as I said, I am not going to talk about non-compliance because, see, there is a very interesting discussion that happened, and all of you who are signing audit reports will know this. We don't use the word called true and fair now. We use the word called as reasonable assurance. We never use the word called true and fair. The true and fair was something, a figment of our imagination. We only use the word reasonable assurance. They are doing the financials, I am giving my opinion, reasonable assurance. I am not supposed to detect any fraud also. Even my audit report, SA 530 also makes it very, very clear. This is what our audit report says. We've got enough of paragraphs to cover ourselves in the audit report, if you want to actually cover ourselves. But if this is the situation and the concept of true and fair is no longer there, then we should be okay, no? We should actually be okay. Because we are not saying true and correct. There was a discussion in the UK, auditors should say true and correct. And they said, no, nobody can say true and correct. So with this reasonable assurance clause, but I mean again I take you back to Ind AS. Ind AS 1, the presentation of financial statements, gives a very interesting clause and says that in case all the Ind AS standards are followed without any exception, there is an assumption that the financial statements are true and fair. This was not there completely in AS 1, but it's there in Ind AS 1. They say that if all the Ind AS standards are followed without any exception, it is an assumption that the financial statements can be said to be true and fair. So, what I will do now is, I will give you all a few on the slide and then I will tell you all a few things which the FRRB has reported. So, most of my data has been from FRRB, some mistakes we only have made in our own financials, some from NAFRA and some from SEBI, those examples there. So, my request to all of you would be that the moment it comes on the screen, you all can probably tell me what could be the possible mistake. So, is this an acceptable accounting policy? Impairment losses, if any on fixed assets, are recognized in accordance with the AS 28 impairment of assets issued by the Institute of Chartered Accountants of India. This is a disclosure given accounting policy in a company, non-Ind AS company, AS company. Accounting policy says that impairment losses, this is my accounting policy. I will also give you all a forewarning. Just because I am putting it on screen, don't think it's a mistake. It is not necessary everything I put on screen is a mistake. So do you think that this is okay? Would you all accept this as auditors or would you want to fine tune this? Don't worry, Pramod will not give negative marks for, will not remove the CP for, Madhunath will not remove the CP if you give a wrong answer also. Don't worry about that. What do you think?
It is incomplete disclosure.
Why?
Management has to do an assessment of the whether an impairment has happened or not, and therefore with certainty mention whether there is an impairment. Here, if any, a bypassing clause has been used.
Where is if any? If any, okay, yes. You are saying assessment has not been made, that should have been very clearly brought out. Okay, he is saying that the management is supposed to make an assessment at least annually. Here they are saying impairment losses, if any, which means that, I don't know, nobody is in the assessment possible. Also, I mean today, he is also a valid point there. The accounting standard says you should at least annually check for impairment. See, there are two things in impairment. One is you first test for impairment. If there is an impairment, then you account for the loss. Here they are saying loss itself is if any, which means that the test itself may not have been done. It's possible the test may not have been done. This is one part of it. Second is also, I think this is a question which all of us need to be a little bit more aware of. Objection here was that AS 28 has not been issued by the Institute of Chartered Accountants of India. It has been issued by the Ministry of Corporate Affairs. Companies Accounting Standard Rules 2006. Don't hold the institute responsible. Put it as Companies Accounting Standard Rules. Don't put Institute of Chartered Accountants of India just because they are on the website. So, if I look at this is an FRRB observation. If I look at this observation, it is very clear that accounting policy in a way is defective because, as he rightly put it, I cannot use words called as if any. AS 28 itself says that if any only you have to account for the losses. Why are you repeating that? AS 28 says you first test for impairment. If any only, then only you have to account for the impairment losses. So it is possible that this accounting policy needs to be reframed. Now quickly I am going to ask you all this because all of us do know about this. And since we are talking about impairment, I always have mentioned this wherever I feel that it is important to mention this. Whose responsibility is to test for impairment of assets? Management, absolutely no doubt about it. How will you inquire from the management whether the impairment has been tested or not? Sir? You will ask them. When will you ask them? Whenever you feel like asking them. Correct? Here's the thing. Especially since you're talking about fixed assets, right? Look at your Caro checklist. All of us love checklists. All of us go by checklists. Article clerks use only checklists even if they are 2 years old. Look at my Caro checklist. What is the first point in Caro checklist will say? Does the company have a fixed assets register? Let's see if we'll come and show a very complicated Excel sheet with some multiple columns, and she will say yes, it is there. Was a physical verification of assets done? You will say I've got a PV report, only one laptop is missing, that's also with the auditor only. It is okay, so fine. And now of course third they'll put all the title deeds and all the what is there in Caro. What is not there in that checklist is where any of the assets tested for impairment. It's not a question in Caro, it's not there in the checklist. Because it is not there in the checklist, my concern is that the question will never be asked. If the question is never asked, it will never be answered. It's a fact, we have to admit it, right? So all this impairment accounting policy, all this comes later. All this comes later. The first thing is that, okay, maybe you all can say it will come in my AS checklist. When I do my AS checklist, probably I ask them AS 28, do you have an impairment? So it depends on what you are giving more importance to, the AS checklist or the Caro checklist. But I would believe that in your Caro checklist, don't go by the paragraph numbers, go by what even auditing standards will probably say. So if you ask this question, they will be forced to answer the question. And it is not just a question of answering a question of saying impairment test has been done or not. You could probably ask them calculations also. You can ask them which assets have been tested for impairment. Impairment testing involves calculations, value in use, fair value, carrying value, the comparison has to be between all of these things. So when that test itself has not been done, these accounting policies will probably become slightly redundant. So I think we have to be a little bit careful about that. This is a cash flow thing. I talk about this in a more general manner. Current liabilities and provisions, they are classified under the cash flow from financing activities. This also has been a FRRB observation. What is the first objective of a cash flow statement from the company point of view? Cash flow timing. That is the first problem. First problem for the person is it has to tally. He is not worried about how much of operating negative operating cash flow, positive financing cash flow analysis, whether the cash flow statement is going concern you can make only from cash flow, not from balance sheet. His only job is, sir, first I will tally it, sir. Then I will see other things. Whatever analysis you want to do, you do. Increases or changes in working capital is a very, I am assuming that everybody follows the indirect method of cash flow because there the changes in working capital will come there. It's a very popular thing, you have to keep on doing it. This company showed it under financing activities. Whereas invariably current liabilities when we talk about it will be from the, it will normally only be for operating activities. More than the question of classification in the cash flow statement itself, I feel that the importance of the cash flow as a document is slightly understated, shall I say. Cash flow is a very, very important document. You look at any of the companies wherein there have been some problems. As I said, I can always go back and trace it. Cash flow, yes, there was a negative operating cash flow, positive financing cash flow. When there is no operating cash flow positive, how are they going to repay the positive financing cash flow? We can ask many of these questions. But this has not been done. So here they said that he put it under financing activities, not under operating activities. Again, if you look at it from the point of view of the FRRB also, what do you give the FRRB? You give them your financial statements only. You give them your financial, that's what they are going to go by. They are going to go by your financial statements only. What you present is what they see. They are not going to do an audit again completely. They may ask you a few additional questions over and above what has been presented, but they generally go by what they see only. What you give them is what they see. They are only going to go on that basis. Analysis of the cash flow statement can provide a lot of insights into how that entity has been operating. Now, operating, financing and investment, we all know that at a very broad level, people say that operating cash flow should be equal to financing plus operating plus investing cash flows. Not exactly matching, but at a very, very broad level. That means it's a very stable company. It's a stable company means, okay, it can last at least for one more year till the next cash flow is being prepared. If that's the situation, how do we analyze it? So presentation of those individual line items in the cash flow also becomes important. We know for a fact that anything directly or indirectly related to the business of the entity, sales, purchases, working capital, becomes operating. Loans, intercorporate deposits becomes financing. Investments in property, plant and equipment, other things becomes your investment. We know that at a very broad level, we know that these are the components of your cash flow. Invariably, they will not change in a company. If there is a change, you may need to know where that change has to be reflected and why it has to be reflected, appropriately where it has to be reflected. One very popular item for all of us, we know very well that this is an important, I already spoke about onerous contracts, so I'll avoid that discussion now. Construction contracts. AS7 had certain requirements. I'll still stick to AS7. Very interesting story about this AS7. AS7 said that construction contracts, POC method, which means percentage of completion method, you will have to follow. Many people started following it. They started saying, okay, POC method is being done, 25% of, some percentage of completion has been completed, revenue has been recognized, whatever. One of the things which AS7 did not mention was, when do I commence my POC method? It said POC method you have to follow. It didn't say when do I commence it. If I am starting a project newly, a real estate project today, tomorrow morning I am starting a project, can I start POC immediately? It will not be possible. I may have to wait for some time for the foundation to come up, other expenditure to be incurred and all those things. So somebody asked a question, okay, very good standard AS7, POC method, very, very nice, when do I start? They did not want to amend the standard. ICAI came out with a really very good document called as guidance note on real estate transactions. Very well drafted document. They said that 25% of the transaction has to be complete. 10% of buyers should have already been found. Certain revenue should have been realized from them. When these three conditions are met, you can commence your POC method. Till that time, please, revenue and costs are going to be equal. No profits to be recognized. 25% construction to be completed. 10% buyer should have been found or revenue should have been found. Certain amount of revenue also should have been, or advance, not revenue, should have been also received from those buyers. Commitment for the project should have been there. If these three conditions have been met, the guidance note said that you commence the POC method. If this has not been met, total cost is equal to total revenue, no profit element. The guidance note became a very big hit. It became even more popular in the accounting standard. People are saying, okay, AS7, okay, go to guidance note. You know when to start. There is more guidance in the guidance note than in the accounting standard. Why I tell you this interesting story is because when Ind AS came in 2017, for whatever reason, we do not know, and they had actually brought out a guidance note on for Ind AS also. For whatever reason, ICA withdrew the guidance note on real estate sector, on real estate transactions. For whatever reason, we do not know what the reason is. The moment this guidance note was withdrawn under Ind AS, everybody said that POC method cannot be done, only complete contract method. The assumption is everybody, because the guidance note became even more popular than the standard. Guidance note was there, guidance note was withdrawn, they said no, POC method cannot be done. You will see that when Ind AS transition happened, most of the real estate companies in India, they said that we have stopped the POC method, we are going to go to completed contract method. Because of withdrawal of a guidance note of the ICA, though there is enough of guidance in Ind AS 115 to say you can still do the POC method. But since we are sticking to AS, I will give you all a very popular line for accounting policy. You may Tuba companies. Sir, what is your accounting policy for revenue recognition? The accounting policy is the revenue is recognized when significant risk and reward has been transferred. Over. Accounting policy done. Over. 1,000 crores revenue. One line accounting policy. You just look at the contrast here. 1,000 crores top line revenue, you have a single line accounting policy saying revenue is recognized when risk and significant risk and reward has been transferred. You take an employee benefit standard, only a disclosure standard, you have got 20 lines accounting policy. There's obviously a problem there. I think what is expected is going to be what is the event when significant risk and reward has been transferred. You have to mention this in your accounting policy. Nobody has to come and ask you this. FOB contract, all those, contracts, CAF contract, you could have different types of contracts. The risk and reward relationship can be different depending upon the contract. But the accounting policy is supposed to capture at least tell me when your risk has been transferred. Don't simply say significant risk and reward has been transferred. Tell me what is the event. US GAAP had a very good principle on this. US GAAP said that the moment you give delivery of a product, you lose control. The moment you lose control, you can recognize revenue. Because in all our revenue recognition standards, we have always been saying that collection is probable, not possible. We have never used the word called as possible. Collection is probable. That means I can give you a product. The moment I hand it over to you, I have lost control. The moment I have lost control, I can recognize my revenue. whether you will pay me or not is not going to question my revenue recognition. I will continue with this. In case you do not pay me after how many years? Provision ever ಮಾಡ್ತೀರಾ? No, after 3 years we'll ask questions, sir, provision ಮಾಡ್ತೀರಾ? The provision may not happen immediately. At least the question will be asked after 3 years. Yes, do you want to make a provision? 3 years has happened. He has not paid you. Will he pay you? You don't ask that question. It's the next year. I saw him last week in KR market. He told me he'll pay. Promised me he'll pay. 1 year just waits. This can go on. But it does not impact, companies have used this delivery thing in US GAAP to do a lot of things. Hewlett Packard, huge revenue recognition. He just went and dumped the laptops. To companies, said, keep the laptop, don't buy it, keep it, he told them. After some time, reversal happened. So, the policy should not only reflect what is your, I won't say quantum, but what is the event? What is the event on which revenue has been recognized? So, give a little bit more details. AS 9 may not ask you to do it. AS 9 may not say, please give more details in your accounting policy. It's not going to come from AS 9. It's going to come from what you feel should be the correct disclosure for the accounting policy for revenue recognition. So, there can be situations wherein the revenue recognition itself can be questioned, whether you can recognize revenue or not. Sometimes, I'll give you some example. I'll give you one example which should be very popular with all of you. Very known to all of you. Defense company, Bangalore only. Main customer is Ministry of Defense. I am talking about March 2020. Each equipment is worth about 7.5 or 8 crores or 10 crores, let us say. And the way this works is that they will produce the defense equipment, call up Ministry of Defense. Ministry of Defense says, Acha, we'll send our people to Bangalore. They will do an inspection. Inspection report is given. Once the inspection report says yes, the goods are shipped at the cost of the Ministry of Defense, not this company in Bangalore. Ministry of Defense says, installation certificate will get, then we are okay, no problem at all. Your responsibility as a company is over. We will shift it from your factory to Delhi, wherever you want to ship it. 20th of March 2020, similar machine for 10 crores was ready. They called up Ministry of Defense and told them that, sir, machine is ready, please come. The machine said, very good, no problem, keep it, will come, they said. 25th of March, the national lockdown. Nobody could come, including Defense Ministry. Machine is ready. 10 crores. No responsibility from the company. They have done all they had to do. Only responsibility required was Ministry of Defense to come there, inspect the machine, give an installation report, and at their own risk and responsibility, take the machine and go. This was a transaction. Ministry of Defense said, lockdown is there. I cannot come now. Keep the machine in your warehouse. Whenever lockdown is lifted, we will come and take the machine. So this company decided to keep the machine in their warehouse. After about 2 or 3 months, lockdown was lifted. Whatever happened, they came and took the machine. But I am talking about 31st March 2020. Can they recognize 10 crores revenue? Sir?
Installation certificate.
Installation certificate has not come. Can they recognize? He's saying installation certificate. This has always been my, but they have given, in the past they have given many installation certificates. Everything has been positive, nothing this thing. So the company here, what they said was, all my responsibilities are over. This is a unique transaction, unique event. He has not been able to come. Had he come, he would have given a installation certificate. He has not been able to give it because he has not been able to come. Force majeure clause. They said that, I have kept the machine here, I will recognize revenue. And in fact, this became a discussion point amongst other people also. So when they asked me, I asked them, okay, fine, you kept the machine, which is fine. Ind AS is something called as bill and hold sales. I can invoice them and hold it on their behalf, assuming all my responsibilities have been over. Ind AS says you can recognize revenue. I told him, he said, yes sir, it is my warehouse sir, it is not my responsibility, come and take it. Have you insured the machine? Yes sir, I have insured the machine. Whose name insurance is? In this company's name. So I told him, the moment you have taken insurance in your name, I go back to AS line itself. I cannot say significant risk and what has been done. You are still having an inventory risk. You are still keeping the inventory risk with you. You will not be able to recognize revenue. Now, this is one transaction wherein all responsibilities required for the purpose of revenue recognition have been done. Because of one force majeure clause, they could not recognize revenue. And the moment insurance had done third-party insurance, you would probably recognize the revenue. But still, the question of installation certificate was still pending. But yet, so the point I'm trying to drive here is you would need to be a little bit more detailed in your disclosures of accounting policy. And what will we disclose? We will disclose only what is fill in the blanks. We will disclose only what is. Somebody should answer. What is not required? What is the minimum disclosure required? Happens all the time. See, SEBI had come out, SEBI gives us some very good guidance in this. In 2009-10, SEBI keeps getting all these brilliant ideas. They told all the companies that you should give the salary of the highest earner, you should give the salary of the lowest earner and tell why the difference is there. CEO is getting some 10 crore salary. Chartered accountant is getting some 10 lakh salary. I'm saying chartered accountant, but just anybody else getting. The SEBI note said that you should give disclosure why the salary difference is so high. What will you give for this? One company in Gujarat, they said, okay, fine, you want now, give it over. They said, yes, this is my salary of the highest earning person, this is my salary of the lowest earning person. Our salary package is as per market standards. Disclosure given. Which market, why market, nothing mentioned. The moment that one disclosure came, what do the remaining companies do? See, always, please remember, we are waiting for that one person to make that mistake. The moment he makes that mistake, all companies said that, as per market factors, market assessments, they use some additional words if required. 2 years, SEBI withdrew it and said, not required, please don't give it to me because I know why all of you are paying so much. You don't have to tell me this now, I know everything. Don't give this on a year-on-year basis. We can't take that risk in accounting policies. That risk we cannot take in accounting policies. In accounting policies, we have to be a little bit more, especially for items like revenue recognition. Again, you look at typically what are main accounting policies. We'll have revenue recognition, we'll have, for example, inventory we'll have, borrowing costs we'll have. So all these standards, be a little bit more detailed in your accounting policy. Okay, the next question I'm going to ask all of you all is, all of us know that Schedule 3, Division 1, Division 2 is there, Division 1 for an AS company, Division 2 for a Ind AS company. All of you have got Excel formats, which we all follow. How complete is your Excel format? When I'm saying complete, does it also include the amendments? This will always include the amendments for some amendments have been made in Schedule 3. Have you taken those amendments into consideration also? As I said, there is absolutely nothing wrong in using what is formats that is available in public domain. Nothing wrong in that at all. Or one sanity check all of you have to do is whether that format is updated. That's all you have to do. And as I said, though we are talking about a post-mortem and all those things, and it's easy to find out mistakes, we had this unique situation in one company when there was a QIP review. and the QR reviewer said that authorized capital in the company is wrong. Authorized capital mentioned in the financial statements is wrong. Actually, as per the RIS records, it is 50 lakhs of rupees. You are saying 20 lakhs of rupees. It does not impact your balance sheet. But Schedule 3 format, authorized capital is wrong. You have not shown the exact authorized capital. If this question is asked to you, what will you all say? Sir? Typographical error. Okay, very good. Very good. Typographical error. Sir, something happened, we do not know. It does not impact the balance sheet. Totaling is not impacted. Net worth is not impacted. Don't worry about it. So one person called up the company and said that I've got a QR reviewer. He's saying authorized capital is wrong. As per ROC records, it is 50 lakhs of rupees. MCS is 50 lakhs of rupees. You are saying 20 lakhs of rupees. Can you please change it to 50 lakhs of rupees? He got a very brilliant response from the company. He said ROC is wrong. He said. Without even bothering about, he just said blanket sentence. ROC is tappu service. ROC is wrong. How can ROC website be wrong? We do not know. He said, sir, ROC website, so many problems. This was one problem. Only our company problem is that. You please go and check that. This person was stunned by this response. He said, what is this fellow saying? ROC itself is wrong. He did not want to take the trouble of finding out what is the actual authorized capital for his own company. So when the CA called me, I told him, please go and ask them how much of fees they have paid for authorized capital. Go to that source document. When they went to the source document, they found it as 50 lakhs of rupees. It was only a question of changing the authorized capital from 20 to 50. For that, we had to do an ultimate, we had to do some 10 email exchanges and try to prove ROC wrong also. This also happens in a few cases. So, we all know this as a practical situation also. In a small private limited company, wherein all the possible items in the balance sheet may not be required to be filled in because it will not be applicable. What do you do for the format? Do you omit it? Do you keep the format? Do you simplify the format? Do you keep the line item separately or say nil? These questions can crop up. Many of you may have addressed this problem. My suggestion there would be that don't tamper with the face of the balance sheet, face of the P&L account and the cash flow. Let that remain as it is. Doesn't matter if you only have share capital in cash and bank balance. Doesn't matter. Let the face of the balance sheet remain like that only. It may look a little bit empty, doesn't matter. Don't tamper with the face of the balance sheet and the face of the P&L account and the cash flow. Inside, schedules, do whatever you want. May not be required to have so much of detailed schedules, but why I am saying this is because we have seen situations wherein even the smallest mistake has been pointed out. I do not want to mention the name and all those things, but we had a very, I think if I tell you this example, I really will feel that it is, what should I say, a little bit difficult to comprehend, so to speak. The NAFRA we are seeing today in India, there is something called as Public Company Accounting Oversight Board of the US. The job of Public Accounting Oversight Board is to ask auditors for their files, check the audit files, typically what NAFRA is doing. And this came about, PCOB came about post-Enron. We should not forget that we are talking about quality today, we are talking about common errors today only because of this one company called as Enron. Enron did a lot of things, which even today we are. Look at whistleblower policy, look at rotation of auditors, look at consolidation mandatory, all because of Enron. Anyways, so what they did was, they said, first said US companies definitely register with the PCO. Then they said that anybody who is registered in the US has got a subsidiary abroad, they also will have to register with the auditors, can be local auditors. They also will have to register with the PCO. So many firms in India who have been auditors for subsidiary companies or US companies, they register. What is the job of the PCAOB? Quality review. Quality review is they come and check the audit file. They will check the financial statements, just like a typical peer review, typical NAFRA review, typical QR review. Startup company, head office US, branch office India. 31st March 2020. 5 transactions in the year. 5 transactions. 3 invoices for sales, 2 invoices for purchases. Service company, fintech company. 3 invoices for sales, 2 invoices for purchases. All 5 transactions in the bank account only. No cryptocurrency at all. PCAOB people came from the US. Please give me a. This person said yes, 5 transactions in the year. This is what our documents are. What documents will you have for this audit? Can you tell anyone? You will have multiple copies of those 5 invoices. Bank account, how many other copies you want, you can take, including direct confirmation of the bank also. The PCAOB inspectors came and asked this firm, where is your audit plan? How many transactions? 5. The audit firm said, this is my audit plan. These 5 transactions, 5 invoices, bank account, confirmation of balance to the bank, trial balance, financial statements. This is my audit plan. Don't you have a documented audit plan? No, we don't have. This is our audit plan. They gave a negative report saying that this firm does not have an audit plan. Imagine you are the auditor, what will you tell them? You would ask them, can you please give me an audit plan for such a company? You look at all your AS, you look at all your auditing standards, how many are applicable to these 5 transactions? Nothing at all. Sampling, 100% sampling. Documentation, let's say 100% documentation. I followed all the standards completely, forget even installments. No related party transactions. What else do you want? So sometimes these things can get a little bit, that's why I am saying, whatever formats you have got, please keep it at ensure that it is updated. Okay, another thing which all of you will accept if I am saying this, you can correct me if I am wrong. Wherever there is a company which has got a gratuity policy or leave encashment policy, the first question we ask them is, actual valuation report banta? Very good. Tondra? Account madidra? Madidi. Disclose madidra? Madidi. Over, that's all. We don't go beyond that. We don't actually, I won't say audit, but we don't actually look at the assumptions in that actual valuation report. Please remember that the actual valuation report is nothing but the actuary who is working on assumptions given by the company itself. He is not doing anything new. He is just using some formula, some PCU method to get the provision for gratuity and leave encashment. All the inputs, number of employees, retention, increment ratio, every input is given by the company. Discounting rate is given by the company. So as auditors, it may be required that you may have to check the assumptions behind this actual valuation. This company, FRLB, also gave a negative on this report. They said that for directors, we don't have a funded plan. All the other employees, we have got a funded plan. It should be opposite of what actually should be. For directors, we don't have a funded plan. We are just making a provision based on estimate, AS 29. But for other people, we are having a funded plan, we are doing as per actual valuation. The question which was posed before the FRLB was, can I have a gratuity scheme which is different for a set of employees than the others? Can I have a gratuity scheme which is saying that, okay, for directors, no funded plan, I only make a provision. And for the remaining employees, can I have a funded plan wherein the assumption seemed to be that only if you have got a funded plan, you should have an actual valuation report. FRB was very, very clear saying that funding is only incidental to the actual valuation. You may still have to provide on the basis of actual valuation only, even if you don't have a funded plan. So you may have to probably go back and look at how those things have also been this thing. Okay, spot the mistake, I said, just to keep all interested. Borrowing and funds directly not related to the acquisition of a qualifying asset are charged in statement of profit or loss account over the tenure of the loan. Your job is to spot the mistake in this. This is like a quiz competition now for you. Find out what the mistake in this is. To the extent not directly related to the acquisition of qualifying assets, are charged in the statement of profit or loss account over the tenure of the loan. So multiple questions can come up here. Basically what they are saying, so this is got related to borrowing costs. Borrowing costs, qualifying asset, capitalize. Correct? Borrowing cost, capitalize, qualifying asset, substantial period of time, capitalize. That there is no doubt at all. Here what they are saying, it may not be a qualifying asset. He is doing amortization over tenure of the loan. Okay, I leave it to you. Only one person can answer what the mistake is.
Should be a tenure of the asset.
Tenure of the asset. You mean useful life of the asset, yes. Useful life of the asset, yes. Should it be amortized or completely written out to P&L account in 1 year is one question which should come up. If I follow borrowing cost standard, only if it's qualifying asset, I have to capitalize. Otherwise, I cannot capitalize. I am making an assumption that I can amortize this. Here again, I think what you all should think of is that you all can ask the company, which AS have you followed for this accounting? He cannot say borrowing cost because borrowing cost does not permit this. The borrowing cost does not permit this. Borrowing cost is qualifying asset, substantial period of time, capitalize. You have a ratio for indirect borrowing cost also. You can find out the capitalization ratio and all those things. If not there, directly profit or loss. Why are related party disclosures important? I think here again I would probably step back a little bit and tell all of you all, just pause for a moment and think. Right from Satyam up to DFHN, Divan Housing. One common factor among all these companies is what? Number of transactions with related parties. Satyam had Mehtas, IFRS had subsidiary companies, Divan Housing had other subsidiary companies. You look at any of these, you name any company, whether India or abroad, wherever something wrong has happened, there has always been some relationship with related parties, some sort of transactions. I think this is a common thing which all of us are aware of. Now, AS, SEBI, MCA, company, everybody says related party transaction, arm's length, disclose it. Everybody says the same thing, arm's length, disclose it. It does not have to be at market price, but can be at arm's length price. It should be very close to the market price. They are giving you all the necessary freedom. We should not forget that any related party transaction, especially in a private limited company, which all of us will be auditors of or are auditors of, it's a matter of convenience for me. It's just convenient. I don't have money to repay a loan. What will I do? I tell my related party, subsidiary company, please transfer some money. I'll pay you back after some time. That's exactly what happened in ILFS. What they call as evergreening of loans. ILFS was the same problem. Multiple companies evergreening of loans. You take one loan to repay another loan, or even to service that loan. Now, since we are only worried about the disclosure aspect, We are not worried about the accounting aspect. I am assuming that accounting will happen at arm's length. This is where I think 550 on auditing standard on related party transactions has used a very, very interesting sentence. They have said that when the auditor is looking at related party transactions, please be a little bit more careful, aware some word has been used. I forget what the exact word. Not been used in other standards. Specific guidance given to the auditor saying that when there are related party transactions, please be a little bit more aware of what is happening. Try to ensure that, obviously they have also seen the fact that multiple things can go wrong in related party transactions. So we have to be a little bit more careful when we are talking about related party transactions. Please remember that I do not have an accounting policy for related party transactions. I only have a disclosure. I don't have an accounting policy. I only will have a disclosure. Disclosure will say that these are the transactions related parties, most of them are at arm's length, or all of them are at arm's length, and they have got the year-end balances. As auditors, I think apart from this aspect, you would also probably have to look into whether those transactions have actually occurred or not, or whether they can be harmful over a period of time. I think those are aspects which all of us have to be a little bit careful of, because as I said, today when everybody is saying that you have to be more careful as auditor, you are not done your job as auditor and all those things, people are asking all sorts of I won't say unnecessary, but questions are being asked. You can look at the internet. There are plenty of examples of cases where auditors have been questioned, not only in India, also abroad. When you all get the time, I'm assuming you'll have the time today because all of you are just filling up your CPEs. But you will not get CPE for watching YouTube. There is a YouTube video on a company called as Carilion in UK, CARILLION, Carilion. Real estate company in UK. This company collapsed in 6 months' time. 6 months' time, we just applied for bankruptcy. All of a sudden, cash flow problem only, just like IFRS, cash flow problem. And there they started a big investigation in the UK and all those things, and asking how can you do this, how can this happen, and all those things. And I think the YouTube also has got some discussions with auditors. All this, the UK set up a committee and all those things. All they asked the auditor was that 15 years you've been the auditor of this company. I'm not saying you're going to say that the company will collapse. We don't expect you to say that. Your audit report is absolutely clean. No warning anywhere. No cash flow issues anywhere. Nothing has been identified. How can you be so confident that the company is going to, when this has actually happened? Again, as I said, postmortem. As I said, postmortem will do a lot of things. See, there are only two possibilities, going concern or gone concern. There is no maybe going concern. That concept does not exist. So they said that when you are auditing these companies, audit report has got enough and more paragraphs to inform us that something could possibly go wrong. We are not saying fraud. We are not saying not a going concern. But there should have been some sort of wording in the audit report which said that yes, it is possible that this is a risk in the audit. You are not saying risk in the audit. Cash flow itself can be a risk. Cash flow mismanagement can also be a risk. Like there are plenty of, you go back here and look at what happened, again related party transaction. Loans given to subsidiary companies not repaid. That's how this also happened. So that is something which we'll have to worry about. Very good question was asked by the FRR. Not FRR, this came about from somebody else. Standalone consolidation audit fees is the same. Is it possible? It is possible because he has done it like that here. He obviously shown it there. What does this show us that? For consolidation, auditor has not charged any audit fees. You see how deep they have gone. They also see, all of us do this. The moment we see financial, says the audit fees is there. That's the first thing we see. But here, this person compared standard and consolidated both same audit fees, which means that for consolidation audit report, nothing, no fees was charged. Free of cost. Bulk deal. I do standard, I do consolidation also. Free of cost. I think we need to be again here. These are all areas, as I said, no. When people start looking at financial statements with such a deep lens, many things can come out. Here the auditor said that, no, my standalone fees also includes my consolidated fees also. That is fine, but why don't you disclose it separately then? Why don't you show it separately in console? It should have been shown separately. I agree that, okay, maybe it's fees which is not very high as compared to the standalone fees, whatever it may be. But please disclose it separately. Nothing prevents you from disclosing it separately. So this is where we can get into this thing. One more accounting policy given. As I said, I will not, there can be plenty of mistakes which can be given here. Deferred tax liability consists of deferred tax on fixed assets and provision for gratuity. We are very good in giving these bullet point accounting policies. Deferred tax can normally come on fixed assets only in two situations. One is depreciation, one is sale of fixed assets. Only two situations when deferred tax can come for property accounting report or fixed assets. Here they said that is what you see later on, no problem. But my accounting policy deferred tax only on fixed assets, not on depreciation. He has never used the word called depreciation, he never used the word called as sale of assets. And provision gratuity, okay, that is normal course, no problem. Okay. Quickly let me take you through this Ind AS. As Pramod was also saying, there will be some people in the audience who have done some Ind AS work, and maybe some people have doing some Ind AS work. I'll be brutally honest here. The chances of errors in Ind AS are more than there is in AS. Obviously because of the fact that these are a completely new set of standards, number one. Second, based a lot on assumptions and judgments, gives a lot of flexibility to companies to do what they want to do. I won't say what they want to do, but they seem to be thinking that if I disclose, I'll get away with, I won't say accounting treatment which is, inappropriate, but I have a choice, I have a policy choice. More importantly, extremely lengthy standards. The standards are so lengthy that you lose interest in reading them after the first few paragraphs. Especially standards like Ind AS 109 and all those things, which are, see, India, we had a small, we still have a small problem because we stopped at AS 29. We did not do anything for financial instruments. AS 30, 31, 32 was only recommendatory. We all know what happens to recommendations in India. If you say recommendatory, what will you say? Recommendatory, no, very nice. Let it be recommended. No problem. When they make it mandatory, then you will see what is going to happen. AS 30, 32 is never made mandatory. And suddenly we have this huge lengthy Ind AS standard which talks about business model, FET, OCI, amortized cost, ECL model and all those things. Many companies who transitioned had a problem only in financial instruments. They were very good in property accounting equipment. They knew exactly what is to be done. But financial instruments, they were completely caught unawares because the concept of fair value, business model, all those things came as a surprise to them. Even today it is there. So, one of the things which ICA is probably going to do, and this is for all of you who will probably be thinking what is going to happen, because we will not necessarily have Ind AS standards. Today in India, as we are speaking today, apart from banks, insurance companies, companies with a net worth below 250 crores, everybody else is in Ind AS. Banks, insurance companies, and companies net worth below 250 crores, all the remaining population of companies are already under Ind AS. Banks and insurance companies, we do not know when they will come to Ind AS because RBI is expecting that there will be a significant impact once banks transition to Ind AS. There will be a significant impact. They're expecting this impact to happen in the last 7 years. At some point or other, they have to transition. But what will happen to the company's net worth below 250 crores, which could form a large part of our clientele also? They are not going to go to Ind AS definitely. We are very clear on that. They will not be Ind AS clients at all. They will not be Ind AS companies at all. ICA is going to revise the existing AS. They already have a project on that. To make these companies also almost on par with Ind AS. May not 100% be Ind AS, but they're going to call it as AS revised or something. They already have some exposure draft study. For some reason it has been stopped for some purpose, but it will come very soon. So maybe in the next couple of years, you will find that this AS revised, and that is where I think a significant portion of our work as chartered accountants, auditors would also involve, because these are the companies which will be auditing on a day-to-day basis, not necessarily having a Ind AS. Some very interesting thoughts on Ind AS come up here. Apart from these lengthy standards and all those things. There are some good things also in Ind AS, not everything is so bad. Classification of the asset depends upon the purpose for which the asset is being used in Ind AS. If you are using it for your own purposes, classify it as property, plant and equipment. If it is for capital appreciation, show it as investment property. If it is selling, show it as asset held for sale. Pretty interesting concept they brought, saying that if depending upon how you are going to use the asset, classify it. Similarly, concept of useful life. IFRS, I'm not saying Ind AS, IFRS always said that best person to decide useful life as asset is who? Not Ministry of Corporate Affairs, not Schedule 2. Best person to decide useful life as asset is the person who bought the asset, person who is using the asset. You can just imagine what will happen if we give freedom to companies and auditors. Useful life is your choice. Do whatever you want. You can change useful life if you want every year also. I did not say what is going to happen. We will look at profit after tax and then only decide what is the useful life of the asset. And in fact, when this Companies Act came in initially, they said that useful life concept came in Schedule 3 or Schedule of the Companies Act. They said that these are indicative useful lives. Now it is not there. Certainly somebody told the MCA, boss, we are using the word called indicative in India. Now what is going to happen? I can put left indicator and turn right. Please change the word. Today what the word is that useful life will normally not be different. I will have to justify why it is different now. I should get on technical level and say that this is what it is. Good example can be your dish TV, set-top box. The schedule says 8 years useful life. Dish TV is saying that look at my past record, 90% of my customers have either stopped Dish TV or gone to alternate provider in 3 years' time. What is useful life then? Obviously 3 years only. I don't require technical reviewer there at all. I mean to do the useful life there. So this is what Ind AS is. Now again, this will interest all of you. And this I think will have to come at some point of time. If the best person to decide useful life of an asset is the person who has bought the asset and is using the asset, who is the best person to decide what to provide for a loan in a bank? Same logic will continue, no? Who is that? Person who has given the loan. Not Reserve Bank of India. Not Ministry of Corporate Affairs. In fact, I take this even further. Not even regional office, not even head office. Branch manager sitting in Salem. He is the person who gave the loan. He knows customer is there, may not be there. Will be there but will not pay. Everything he knows. RBI doesn't know about this. RBI says, oh, standard asset S3, okay, provide 60%, no problem. Oh, standard asset 0.4% to provide. The asset may not be standard at all. All you know. So the Ind AS gives this beautiful concept saying that ECL model, develop a model every year, tune the model every year. RBI is also working in this may interest all of you all again. People who are doing bank audits. This may interest all of you all. RBI is saying a very nice thing. I hope they come out of the circular very fast. I hope they implement Ind AS very fast because it will definitely help all of you who are going for bank audits. For NBFCs, what RBI said was you have to use the ECL model, you have to use Ind AS 109. There is no choice, you have to follow it. For banks, what they are trying to say is, and they'll also bring this out for NBFCs, but more importantly for banks because all of you will be doing bank audits. And all of us know this very well. What are the two main things you have to do in bank audit? Bank audit. Two main areas you fill up. Not fill up. Okay. Look at two main areas. What are the two main areas? NPA and LFA. That's all you want to do. RBI is giving out this beautiful concept saying that the IRAC norms, prudential norms, should be the minimum you should provide for a asset. Where NPA minimum should be as per IRAC norms. However, if a bank wants to provide more for a specific asset or a group of assets, they can use the ECL model. They will probably come out with a small tuning of this or fine-tuning of this policy, but this is already in the recommendation stage there. It will probably come out. This is going to help a lot, all of you all, who need not necessarily worry only about prudential norms now. You look at the valuation report. Why do all the valuation reports come only on 29th of March? Same value for us, so we can ask so many questions. I am not getting all those questions. But this gives us a window saying that, Ind AS gives us a window saying that you have known that this loan has to be provided for. Don't be bound by the prudential norms. Use the ECL model, provide for more for a loan. Banks may take it a little bit more carefully. They may not want to provide for this completely. So you could have situations where individual banks can give some limits to managers at the branch level, say that you can't go beyond this provisioning on those things. But still, I think this will work very, very well because it talks about this impairment from that point of view. Some other problems have also cropped up. Entity statement is followed Ind AS, but all the ritual as per AS only. They have said that we have followed Ind AS accounting standards, but all the AS standards only, the formats have all been as per the AS standards only. Again, all these could probably be first time adoption issues because at the time of first time adoption, we all know this is a fact, a lot of challenges did come about in Ind AS implementation, which happens whenever any transition happens. We are aware of the fact that there will be some challenges here. So some of these mistakes can probably be traced back to the fact that these were first time adoption challenges which will probably not be repeated subsequently. But again, it also shows a certain amount of care could have been taken in looking at these particular disclosures. I mean, for example, not using AS at all. That could have been something which could have been definitely taken care of, right? I have used this as OCI temptation just to tell you all this because those who are only aware of, a little bit of knowledge of Ind AS can probably understand what I'm trying to, get what this concept of OCI is. OCI means other comprehensive income. In Ind AS financial statement, profit or loss account, you will have net profit as a profit or loss account, you will have components of OCI. For all practical purposes, Ind AS 1 tells us what can be a part of OCI. Actual gains and losses is a good example, will be a part of OCI. Changes in revaluation surplus would be a part of OCI. Translation of foreign operation, foreign currency differences will be a part of OCI. So there are some components there. If you look at these items, it is very clear that the purpose behind OCI is to protect the net profit. All of these items are notional items, unrealized items. And Ind AS 1 gives us about 9 items, and now after the insurance items, 10 items will be a part of OCA. What we should remember is only these can be a part of OCA. But sometimes in the urgent finalization, tomorrow audit committee meeting is there, journal entry is being passed, debit property, plant and equipment, credit ಎಲ್ಲಿ ಮಾಡಬೇಕು ಎಲ್ಲೂ ಗೊತ್ತಾಗ್ತದೆ ಸರ್ OCA ಹಾಕ್ಬೇಡ ಆಮೇಲೆ ನೋಡೋಣ is anyhow there, we'll see afterwards. Anyhow there's talk about some project of recycling back to paid account, we'll see afterwards. Please remember that OCA is not a parking ground. You cannot park items in OCA for the purpose of parking. Invariably in Ind AS, if the debit is to balance sheet, credit will be to paid account or vice versa. It will, within balance sheet items, hardly anything will be there in Ind AS. So, just because many people feel that it is like an appropriation of profit, we should not be tempted to put in items in OCA. We should be sacrosanct what goes into other comprehensive income. Idea is very, very clear. Even your EPS calculation in Ind AS is based on not OCI items. It will be net profit only. Even your EPS calculations are only on the basis of net profit, not on the basis of components of OCI. So again, we have to be very, a little bit careful what is to be done here. All of you may have probably heard of this concept of fair value when Ind AS came, and even today we are talking about fair value. Everybody says fair value is so difficult in India, what to do for fair valuation, it will impact us so much. In fact, whatever provision you are talking about as per the impairment norms is nothing but fair valuation, that's all. If you are going to provide for loans, it's going to be a fair valuation as per the, Ind AS 109 standards. Fair value as a concept is nothing new really. Go back to AS2. What is NRV? What is NRV? Sale value, whatever fair value, we can probably say it is equal to. I have not used the word called fair value, that's all. For all practical purposes, it is fair value only. You take your AS28 impairment standard, value in use they say, fair value they say. Value is nothing but your fair value for all practical purposes. So what has happened is we have used the concept of fair value or something called as fair value without saying it is fair value. What Ind AS has done is they have expanded this concept of fair value across a large number of standards and made it common, made it almost like mandatory. So Ind AS almost seems to say that balance sheet as at 31st of March 2024 means it should reflect the fair value of assets and liabilities on that date, not before, not after. When I say balance sheet as at 31st March 2024, to a large extent it should reflect the fair value of assets and liabilities on 31st of March 2024, not one day before, not one day after. Similarly, we had this discussion. Profit and loss account. When IASB came to India, they asked them, what is this meaning of this word called profit and loss account? How can you have profit and loss in the same year? It should either be profit or loss account, or it can be income statement. IASB calls it as income statement, because income can be negative. Ind AS also says profit or loss account means profit or loss is incurred during the year, nothing before, nothing after. If it is before, restate it. If it is after, discount it. That is what Ind AS concept is very clear. When this IAS became, they also told the MCA, what is this word called balance sheet? Why are you calling it as balance sheet? We got a beautiful word called a statement of financial position. Why don't you use the word called statement of financial position? What is the meaning of this word called balance sheet? MCA was getting very, very irritated. They said, look, boss, this is balance sheet. For us, it has to balance it. So, don't ask why we got it. Profit and loss account? Yes, profit and loss account. I can have profit and loss in the same year. Look at Air India's balance sheet. I am saying loss, they are saying profit. Same year. You can have it. So there is nothing wrong in this. Incidentally, what now has happened? Even IAS is using balance sheet only now. They have taken our concept also, they are using balance sheet. Though they use the word called profit or loss, they don't use the word called profit and loss. This is a pure AS wording. Again, AS wording coming to Ind AS financial statements is something which is there. Again, something on MAT rate entitlement which is there. So I can go on this. I mean, I can give you a lot of other such mistakes also. But if you want me to summarize it, I think most of the errors we have noticed have been on a few standards only, in few areas only. You look at this, for example, a very interesting thing came out. This is nothing but a toll equipment. Nothing but a toll equipment. The question came up whether it is PP, whether it is intangible asset, or whether it is investment property. It's a pure Ind AS company, of course. PP means own use. Investment property means capital appreciation or rental. Intangible asset means right to receive. Right to receive is not right to the equipment. The equipment is a physical infrastructure. It is still my PP only. I can still have an intangible asset, the right to receive. It depends on my contract, whatever they call HAM projects, TOT projects, whatever they call it, annuity project, whatever they have. I must still have a right to receive. That right to receive is intangible asset, not this building you are seeing when you pass the toll gate. When you pass it, that is still PP for the company only. Asset being used for the purpose of their own benefit to get further approval. Look at the definition of property of fixed assets in the framework itself. Asset is there, control is there, economic benefit is there. Straight away classified under PP only. No other clause. I also told you about this. Some Ind AS standards can also present some challenges. I told you about some complicated terms and all those things. Ind AS 115 on revenue has got this rather unique concept called as significant financing component. I won't take you all into the technical details of this. I understand that the purpose is to get your CP, so all of you have sat at 740, I will get your CP, don't worry. I will not take you out to the technical things of SFC and all those things. In effect, what they are trying to say is that if I am going to sell you an equipment after 2 years, let us say 1 year, more than 1 year, 18 months, I have taken money from you in advance. In effect, the customer has funded you. You will have to build up a notional interest income. Interest cost, because it is funded you. So, it works like this. He has paid me 4,000 rupees today. I am going to pay him, I am going to give him the goods only after, let us say 1.5 years, 18 months. Entire amount has come today. In effect, he has given me a funding. They say use your discounting rate and do an interest calculation. You will have to account for this. So it will become 4,494 approximately. So 4,000 will be my sale value, 494 will be my significant financing component, interest. If I tell you how to pass this entry, will you do it? First question I will ask you. I am sure this question is going to come up. What will GST officer say, sir? Do I have to pay GST on this? The moment it is shown as interest, income, finance cost, finance income, you never know. GST officer may say, please pay out this also. That's why I told you, tax factor is very important. I'll always give in the back of my mind, will I have to pay tax on this? Answer is yes, better avoid it somehow. Say it's not SFC only now. Don't give accounting policy, never you have to worry about it. Don't mention accounting policy. See, many of these concepts are actually slightly problematical in the Indian context because our structures are different, our tax laws are extremely different from what it is in other countries. But again, they go by substance over form. They are saying substance over form. So I may have to take the effort of disallowing this in income tax and also not offering for income tax as well for GST. But the fear factor always comes in saying that I may want to do it, but is he going to accept what I am going to do? That becomes a factor for us. So we have to keep that also into consideration here. Okay. As far as disclosures, I have just put one question mark because all of us, we know what we will do. AS or Ind AS, the first thing we'll do is, what will we do? We'll pick up Infosys annual report, we'll pick up TCS annual report. All of us have done it, we have also done it, nothing wrong in that. Only thing is change the name of the company and all. That you all please ensure that it is done. Also, any of those accounting policies may not be applicable to your client. So don't repeat financial management, there are no financial management in the balance sheet. So there is no harm in doing this, but no, one person gave me this thing, he said, sir, Ind AS management, so not running. Accounting policy 18 pages. All financial instrument, risk factor, everything is given. No financial balance sheet and the financial not there at all. Financial sir, why you provide all these things? Oh, better than payment. Then ask what, then you know what has happened there. He has done all the hard work. All the hard work has been done. But that last editing, that is very, very important for all of us. Accounting policy is fine. As far as disclosures are concerned, my humble request to all of you all will be that please look at not only, I have already mentioned a couple of examples here, not only what others have given, the idea behind this is very, very clear. Forget opening balance, forget closing balance. Whatever has happened during the year, you are supposed to give not only quantitative information but also qualitative disclosure. 2 lines on that, that's all is required. Provisions, for example, opening balance was this much, closing balance was this much. Don't worry about opening balance, closing balance. Why did your provision increase during the year? 2 lines on that, just add it. That your disclosure has been complete. You don't have to worry about other parts of it. The last point I mentioned before I close is, lot of discussion is going on now about this audit report. And as all of us are aware, I still maintain this, that if we want to say something in the audit report, we've got a paragraph there to say it. We've got key audit matters, we've got emphasis of matter, we've got other matter, we've got something called a qualified report, we've got what is adverse opinion, and all of us hopefully will not have to have a situation where we have an adverse opinion at least. Key audit matters are supposed to be the significant risk which the auditor has faced during the audit and how he has dealt with that risk. Common items can be revenue recognition, estimates made on revenue recognition, IT controls, ERP systems. All these can be popular key audit matters. Many companies have reported and many companies are still reporting this. EOM is nothing but something which the company has disclosed in their financial statements which the auditor wants to draw attention to. For some reason, company is saying that I am a going concern. Auditor is saying I don't want to pass judgment on it. Please look at the disclosure. Why they are saying it's a going concern? They mentioned something there. You form a judgment based on that. Drawing attention to something which the company has already disclosed becomes an EOM. So very clearly, if the company has not disclosed it, it does not become an EOM. You cannot show it as EOM. It will become other matter. Other matter is something which the auditor wants to draw attention to. Company has not disclosed it. Auditor wants to say this may not be a going concern. There could be some risks in cash flow. Any other point which auditor feels is required. Provision for huge legal expenditure. Anything. For example, your telecom licenses could also be a factor which would impact the cash flows of many companies. So those factors will be a part of your other matter. We also have had discussions whether it should be a qualified report or an adverse report. About 15 days back, NAFRA has come out with a order against an auditor saying that you should not have given a qualified report, you should have given an adverse report. Auditor qualified the report saying that consolidation of subsidiary has not happened. NAFRA is saying material subsidiary company, huge impact is there, you should have given an adverse report, not only a qualified report. But as I am saying again, I repeat this, I should be able to defend why I gave a qualified report instead of an adverse report. NAFRA has got their point of view. Manjunath may have his point of view. You may have your point of view. This is a matter why it was not consolidated. The poor auditor has given an opinion saying that I got a legal opinion saying that some dispute is there. They did not accept it. They said no, you have to give an adverse report, not a qualified report. So we need to be within these 5 paragraphs of the audit report. We need to be absolutely sure why we are putting something in a particular paragraph. And that is what has been mentioned here. Okay, all this is fine. As I said, we can find out errors, you all can find out errors, everybody can find out errors. How do we avoid errors? In fact, I'll probably change this question. Can we avoid errors? Answer is going to be no. Can we minimize errors?
Yes.
Answer is going to be yes. What we should do is try to ensure that 2 things. Errors are minimized, and second, same error should not be repeated. That we should be very, very careful about. Authorized capital last year wrong, this year also I can't make it wrong. That will be a problem. That's a real serious problem. So I think what we should do is avoid errors or minimize them. We can only minimize them. And I would probably think that even before we get in as auditors, and I mean I understand this may sound a little bit difficult to do in all the companies, but I think we should tell the company that don't give this to me at the last minute. Do a review yourself. Just like how we have a peer review, you have somebody inside to review your financials. See if everything has been done properly. Once that check has been passed, once that test has been passed, then you send it to us. At least by the time we are reasonably sure that somebody else has looked at it. It's a very open secret that the more people who look at financial statements, the better it is. At least independently. So if the CFO or the accountant or whoever the person has prepared the financials, tell him, give it to somebody else in the company. Let him do one run through all the schedules, all the financials, all the disclosures. Once he has done, then you send it to us. A peer review system within the company itself, or don't have to call it as a peer review system, a self-review system within the company itself. From auditor's side, it will avoid a lot of repetitive mistakes, which I think we can insist on now, because considering how the things are going today, I think we can definitely insist on this. Ask these companies to prepare these things and then send it to you. Our job then becomes easier because we know that one level of test has already been passed, so we can, only look at the second level and just do a much broader calculation. Okay. So this is basically what I wanted to hear. I wanted to tell all of you. Thank you very much. I will take a few questions if required. Thank you very much.
Members, common errors should not become very common for all, right? One of my professors used to say, even Mohan sir also said, do a different mistake every time, every day, but do not repeat the mistake what you have done yesterday. And if I can add a sentence, learn from mistakes of others. Mistakes of some firms or bigger organization rather can be learned as to what went wrong and how serious the mistake or error is, and how serious the regulator is looking at it, and how government looks at it. So let's be vigilant, members. With that note, members, only an expert with that subject for more than 3.1 decades on both sides, that is both as auditor and auditee, only can bring in that kind of a fantastic session with practical examples. A round of applause for that fantastic. Thank you so much, sir. On behalf of members present here and all the NC members of Bangalore branch, would like to hand over a gift voucher to speaker, and as a token of gratitude and respect, can I request CA Siddharth Javadi to come out to dais and then do the honors, please. Thank you. Thank you, members. Let's meet tomorrow at one day seminar for 6 hours. Thank you.